Welcome back to Strongman Personal Finance. Just when I ran out of content to make, because, my whole channel is nothing but roasting. I provide zero value, unlike Everything Money. Just when I ran out of content, Everything Money drops one of the most clownish videos I have ever seen. RETF strategy that beats the market. So apparently, Paul Gabriel, this massive daddy's boy clown, Richie Rich right here, has a simple strategy where you can just beat the market, bro. It's so easy to beat the market. Like, 3 people have done it consistently for decades. It's so easy, bro, right? So let's see what old Small Gabriel, who we all know has massively underperformed the market. People laugh at me because I buy VT. VT has crushed Paul Gabriel, nuclear obliterated Paul Gabriel, okay? Never laugh at my VT ETF again when you compare me to this clown with 212,000 subscribers. Bro. So let's go ahead and see what Small Gabriel has to say about ETF strategies that beat the market because it's so easy.
This is our ETF strategy that can actually help you beat the market. I used to believe, like most people, that you can't beat the market unless you buy individual stocks. We always look at all the great investors out there and they've always been individual stock pickers. But that's likely incorrect. You can absolutely beat the market with low-cost ETFs, and I'm going to show you how right now. So in this
Technically, yes, you can beat the market by buying different ETFs. You could buy a market ETF, 95% of your portfolio, and then you could buy a sector ETF that's 5%. And that sector may outperform the total market. It's entirely possible. Yes, it's possible. But the question is, can you do it? And can you do it consistently for 30 or 40 years? The answer is no. You're not going to freaking do it.
video, we will discuss a 2-fund ETF portfolio that has the potential to beat the market. We'll go over what those 2 funds.
Every 2-fund portfolio has the potential to beat the market if you buy it at the right time. It doesn't matter what ETF he throws in here.
Are how to use them in your portfolio, and finally, do a deeper dive into the numbers. But stick with us throughout this entire video because at the end, I'm going to drop my personal step-by-step plan for what I think you should do and how you should execute this exact plan. So first, from Vanguard's own website, the Vanguard 500 Index Fund ETF, which is the ticker symbol VOO, tracks the S&P 500, which is the 500 largest companies in the US. As it stands, the top 5 holdings for VOO are Apple, Microsoft, Nvidia, Amazon, and Google. Pretty nice, right? So the great part about VOO is that you not only become part owner of the top 500 companies in the US, but you pay extremely minute management fees on the fund.
There you go. That's all you need. Why do we need to complicate this by buying 2 ETFs?
Fund manager is only making moves in accordance with the S&P, making it a passively managed fund that charges just 0.03% in fees. How low is that? For every $10,000 you invest in that fund, the total fees are a mere $3 per year.
Man, I wonder how that stacks up compared to your software, Small Gabriel.
About that. $3 on 10,000, when the average mutual fund is going to charge you between $100 and $200 a year for that exact same 10,000 and will not beat the market over long periods of time.
I just think about how much you pay for his software versus the fees that he quoted there. And I guarantee you most of the people that pay for his software do not have a lot of money. Because if you have a lot of money, you probably go to like a financial advisor, okay? You don't go to a freaking clown like this. So he's taking his sweet time to tell us how we can beat the market. It's so... this is the most BS video in the world, okay? But I'll give him a chance. Maybe he has devised a simple, just buy the dip strategy. It's easy, bro. That beats the market.
I've said this 1,000 times. Warren Buffett says it. Every great investor I have heard says this. If you want to match the market, not pay a lot of fees to a financial planner or some mutual fund that'll only eat away at your returns, invest in a low-cost ETF like VOO or SPY.
Yes, U.S. stocks, obviously. Not the total U.S. market, but only the top 500 because over the last 10 years, VOO outperformed VTI and VT. I wonder why everybody's pushing VOO.
Both of these have practically inconsequential fees, and they're going to match the market and diversify you into the 500 biggest companies in the country. And on top of that, you don't need to worry about what companies that own, what companies are entering. It does it automatically for you. Now, with that said, there is a way to even get above that kind of return over the long run that doesn't involve individual stocks, because you'd only match the market if you invested in VOO alone. So guys, just like 2000.
Yes, and that's what you want to do. That is the ideal. The second that you start deviating and buying other crap, that's when you don't match the market. That's when you're probably going to underperform the market. You see what happens here? The more you complicate it with stupid strategies like this massive freaking clown is trying to pump on you, the more likely you are to underperform the market. buy the market, shut your mouth, and go to the beach.
I think we're in a tech-driven bubble right now.
Recordings just got better. Hey, it's Dana from StreamYard. I'm so excited to announce that
We have all-time highs on these high-flying tech companies. First it was EVs, Bitcoin's been involved, it was all these other things, now we're in the AI bubble. NFTs we've seen go down to zero, and this has led to some insane valuations, especially on large cap companies. And these valuations are probably going to continue for a little bit longer. How long? No clue. And anyone who says otherwise has no clue. But my guess is that the result in the tech world will be somewhere along the lines of what happened in the dot-com bust. Will it be?
No, it's not. Look, in the dot-com bubble, I would say was probably more akin to some of the clown stocks that we saw in 2020, 2021, where you saw a bunch of massively unprofitable, no revenue, nothing clown stocks go up massively. Okay, that kind of sounds like the dot-com bubble to me. What does not sound like the dot-com bubble is large cap US tech now, which is insanely profitable and still growing at a pretty respectable pace. This is not the dot-com bubble. Dot-com bubble is clown stocks. Large cap tech, I mean, maybe it's overvalued. I don't know. Maybe it's not. Maybe it's undervalued. Who knows? Large cap tech is highly profitable. This is nothing like the dot-com bubble whatsoever. But the valuations, bro, it's so easy.
An 83% drop like we had in the NASDAQ back in 2000? I have no idea. Probably not, because companies today in the tech world are making a lot more money, and they're not as insanely overpriced on the high end as they were back then. But still, it could fall significantly, maybe 50% or more, probably at some point. But when? I have no idea. So here's where you can take advantage of this potential bubble. Invest in the second ETF of the two-fund portfolio. Now,
this is so stupid. You could buy any ETF, any stock. You could buy a crypto. You could buy VOO and a crypto that outperforms VOO as long as you time it correctly. That's the key. That's the hard part. If you could time correctly all the time, you could just buy individual stocks or whatever all the time. The hard part is timing stuff correctly to outperform the market. And that applies to individual stocks and to ETFs.
when I say take advantage of it, I'm not meaning buy it today. The tech-heavy NASDAQ is currently down about 8.
So we need to point this out here. The NASDAQ is like, it's a market. It's a stock exchange. It's like a digital stock exchange, right? This ticker symbol is the company NASDAQ. This is not the NASDAQ index. He's talking about the NASDAQ and the NASDAQ 100 being overpriced, and then he shows you something entirely different. He shows you one stock. This is not the NASDAQ index. This is a company. Their editor needs to be fired. It's so embarrassing how their videos don't match what they're saying.
8% from its all-time high. But the key here is, if you're able to buy the NASDAQ in the Invesco QQQ ETF, which is the ticker symbol QQQ, which is the top 100 companies in NASDAQ, if you're able to buy that at reasonable levels, you'll probably do well.
If you time it right, you'll be able to do well. If you bought Dogecoin at the bottom, you would do well. If you bought Poopy Fart Coin at the bottom and sold it at the top, you could do well. It's so easy, bro. Just wait till the NASDAQ is undervalued. It's overvalued right now, right? You know, it's a tech bubble, you know? But if it becomes undervalued, then you buy it and it's easy. Do you see the flaw with this reasoning? That's the problem. You don't know when it's over or undervalued.
Why? Well, tech companies that tend to have really high gross margins, really high profit margins, and more importantly, they're able to reinvest at high rates of return for long periods of time.
Just buy large cap tech, bro. Past performance is all that matters, bro. Large cap US tech stocks, bro. This is like clown level, okay? Every genius on YouTube, what do? They pull up, oh, what is the best performing ETF over the last 10 years? Oh, it's QQQ is probably high up on that list. Well, since it did good the last 10 years, it's going to do good the next 10 years. That's the geniuses of YouTube. Okay, that's not how investing works. And he's doing the same thing. What a moron.
This isn't the old days of holding a manufacturing plant that took a lot of money and generated small returns. They're able to reinvest and get much, much higher levels of profit, which will drive their profit up even higher. That's how you compound to much higher rates of return. Now, what I'm saying here is, I don't want you to market time. That's not going to work. What I'm waiting for is more reasonable valuation levels.
Don't market time, but wait for reasonable valuation. What? That's market timing. Not market timing is dollar cost averaging into an index. I don't market time. Every 2 weeks, I buy an index. That is the essence of not market timing. buying it at a reasonable level is literally market timing. How is this not market timing?
So guys, here is the chart comparing it to total return, comparing it to the S&P 500.
Oh, look what happened in the past. So we can therefore extrapolate that into the future. It's so easy, bro. I wish I was this stupid and just bought QQQ. Maybe I would be a billionaire in 2050 because that's how it works, bro. If it went up a lot, it's going to keep going up a lot. Maybe that is the freaking truth.
If you bought QQQ on January 1st, 2020, this is the chart. It's now barely beating the S&P 500 in total return, and it took until COVID, a little bit after COVID, to surpass it, okay? So all along this way, that NASDAQ 100 was trailing the market. But let me just change one thing here. Let me go backwards 1 year to January 1st, 1999 and show you that chart. Just back 1 year. Look at the total return now.
If you buy it at the correct time, which is so easy, bro, and then you hold it for 20 years, which you won't because you'll be watching everything money and changing your portfolio all the time, you'll crush the market, bro. So just buy it at the perfect time. It's that easy.
780% versus 454% of the S&P. Why? Because we had this big tech bubble right there.
Show us Bitcoin, Paul.
Look at how much QQQ skyrocketed. Now, if you bought here at the top, you didn't see your return even out for a long time. That sucks. And that should be your concern. However, remember, what I'm trying to sit there and say is just wait for reasonable levels of valuation. Here's the key. This was unreasonable. This was also unreasonable.
It's just circle a chart, bro. It's that easy.
Remember, markets will go back and forth like a pendulum. It'll go from massively euphoric to completely irrational on the other side. Irrational on the high side, irrational on the low side. That's what makes averages. And what I'm asking you to do is just be a little bit patient. Now let me show you the returns here. The annualized return of QQQ from January 1st, 1999 is 9.2%. Total return. S&P 500 is 7.2%. So a solid 2% per year beat. The previous one, they were both at 6.9 and 6.8%.
This is so irrelevant. Past performance is not indicative of future performance. This is, looking at charts like this is clownery level 101.
From January 1st, 2020. Now, let me show you if you were smart enough to invest at the bottom of QQQ. Now again, that's completely irrational. What I'm asking you to do though is start buying before that.
You're completely irrational, you freaking manlet dork.
When it's still coming down. Look at this return. 1,400% on QQQ versus 600% on the NASDAQ.
That's not what's showing on the screen. Their editor needs to be fired, man. I'd see.
From June 1st, 2003. And look, it was pretty much even up until the financial
Okay, there it is. Now we see the numbers. What an idiot.
crisis, and then tech started to really take off here. You need the dollar cost average and continue to do so. My guess is that
So dollar cost average, but then also buy it at the correct time. I'm not just doing this to troll everything money. I don't understand what this video was trying to say. Do you time the market or do you not? Because if you're not timing the market, how are you not going to buy it at reasonable or unreasonable valuation? It makes no sense what he's saying. Am I the clown here? Maybe I am. Maybe Paul Gabriel, because he has more subs, is the real genius.
as these top 100 companies are able to compound that profit and reinvest and generate higher returns,
so
that if you pay a reasonable price
bro, US stocks, bro, large cap tech, bro, it's so easy, bro, just buy the dip, bro.
For them, you'll really be able to get outsized returns. If you bought at the right times, you absolutely crushed the S&P 500. And
You should dollar cost average.
You'll also see the chart that if you paid a poor price, it took 15 or 20 years for the QQQ to actually surpass S&P 500.
Bro, just buy at a good price, bro. It's so easy, bro.
So remember, I'm not telling you to eliminate SPY or VOO. What I'm telling you to do is own these together. In other videos in the past, I've told people, instead of betting on an individual company, bet on a sector. If you think a sector is beaten
Which invalidates your entire channel, but okay.
down, bet on that sector. What I'm asking you to do is that same thing with QQQ. I think it's too early to start on an investment in QQQ today, just based on how overvalued the top 100 NASDAQ companies are, in my opinion. But
Yeah, but you should dollar. It's easy, bro. Like, in my opinion, I just know these top companies are massively overvalued, even though I've described how amazingly they can compound their profits into the future. But they're definitely 100% overvalued because I'm Paul Gabriel.
if you wait for more reasonable levels, and then dollar cost average for the rest of time, you're likely to do well. Now remember, the reason I like text...
Okay. Do I have to watch this whole video? Oh my God.
Stocks is they're able to reinvest at higher rates of return and get much higher profit. That is the key as to why I believe if you pay a reasonable price for tech companies, that you can absolutely get higher returns and also...
Wait, what was that dividend thing? Hold on a minute.
Average for the rest of time, you're likely to do well. Now remember, the reason I like tech stocks is they're able...
And they're showing what is... He's talking about tech stocks, and then the screen shows dividend. This is the most BS. Like, I don't have high production quality. I'm not going to sit here and say I do. But holy crap, this is bad. Well, if we're talking about tech stocks here, and then he has a schlong on the screen. Is that how bad it's going to get at some point? I hope they do have a schlong on the screen. Let me be your editor, Paul Gabriel.
To reinvest at higher rates of return and get much higher profit. That is the key as to why I believe if you pay a reasonable price for tech companies, that you can absolutely get higher returns, and also why tech companies deserve higher valuations than your garden variety factory business. Let me give you an example. Let's say there are two companies.
Okay, now we're getting to clownery here. This video, you know what? At this point, I'm doing this for fun. Like, I know nothing's gonna happen. They're probably gonna have 1 million subs at some point, and Paul's gonna have a harem of hot 10 models that just fluff him on command because he deserves it. He's just such a smart, genius man, and that's just how it's gonna be. But at the end of the day, you gotta learn a lot of stuff for yourself and really think about everything you hear critically, because a video like this it's useless. Like I could literally make this same video but talk about poopy fart coin. I'm not joking. Poopy fart coin. And I could say you could buy poopy fart coin at a good price and you could outperform the market. And that would be the same value that this video would provide, because it's just as true. Stupid. All right, guys, have a wonderful night. Cheers.